Okay, welcome everyone. Welcome. This now Saturday. I think this is day nine. Day nine of we doing this every day. And as I said, we will not stop whether it is weekend or not weekend. We don't do weekends. Okay, normal people do weekends. We are not normal. If you're normal, you will not make it. No, I think by now all of you know I'm not normal. No, I'm really not normal. And because if you are normal, you cannot be trader. You know. If you are normal, you are too afraid to take risk. Normal people are not capable of taking risk. And trading is all about risk. And everything what everyone is doing in trading is trying to avoid risk. That's why they go from strategy to strategy, from mentor to mentor, from course to course, just so they don't take risk. Every trade that we take, it is always a 50-50. The chance of a win is a 50-50. Trade by trade, the chance of you winning that trade or not winning that trade is 50%. And because of that, that dog some attention. Good boy, go, go. Because of that, we avoid taking risk. We don't trade. We go from course to course. Okay. But from now on, we don't do that anymore because we know the reality. The reality of trading is that we need to become comfortable with taking risk. Okay. So what is a strategy? A strategy is nothing else than an excuse for us to get in a trade. That's all a strategy does. An excuse for us to take a trade. Trading is what happens after we are in a trade. What you do before that, all the lines on the charts, all the nice things that we do before that, that's all not trading. Trading is what we do after we are in a trade. The way we manage the trade, the way we get out of the trade, those things are important. How you get in a trade is not important. That's the strategy, and that's what most people, most folks, just read the comments in the group. Any trading group, all the talk is only about strategy, meaning it is only about how do I get in a trade. Well, that part is not important. As I said, I think before, there are traders that get in the trade, that get in a trade without looking at the charts. Okay, so but we are chart trade. So for us, it's okay. We need to know some things about the chart. And the strategy that we have chosen, which is just an excuse to get in a trade, is EG. Okay, we need the excuse that we can repeat every day or a few times a week. Okay, so see this as nothing else than just an excuse. Okay, then it will become for you more easy instead of seeing this like a science. Some of you have engineering background. If you are a programmer, you will have very hard time with trading. If you are engineer, you will have very hard time with trading because you will look at trading from a scientific perspective, from a mathematical perspective. From a mathematical perspective, we don't have any data that one of this SOP is better than the other. Okay? Trading is more closer to gambling than to science. So what we do as traders, we are professional gamblers. But the difference between us and people who go to real gamble places where they gamble, with trading, we can make sure that the odds are a little bit in our favor. Okay? In a casino, when you go to a casino, the odds are in the favor of the owner of the casino. But even for him, the odds are, I think it's something like 51% is it in the favor of the owner of the casino, 51%. And 49% is in your favor. So meaning if you go to casino, the chance of you making money is 49%. Okay? That's why the more you The more you gamble in casino, the more you play in casino, the higher the chance will become that you will lose because the odds are against you. And in trading, we do our best to make that the odds are a little bit in our favor. Okay, and strategies are just for that. They are just excuses. They are just ways to make the odds a little bit in our favor. And trading is what happens again after you enter, after you click on your mouse and after you are in a trade. That is trading. What we do before that, all those time frame analysis, choosing which time frame to enter, choosing when to enter, this all not trading, this all analysis. To understand EG, we need to understand a little bit of candlesticks. Okay, for some of you, this will be very basic. Okay, but I need to say it because we have some beginners, and I will make this video so whenever we get some new beginners in the group, so they have some video to look at. Okay, so we will start from the start. To understand EG, you need to understand candlesticks. And candlestick, what is in candlestick? These are candlesticks. Okay. Does any one of you know how old these candlesticks are? When is the first time that people start using these candlesticks? Okay, and then I will go in trading view and show you how this works a little bit. This candlestick, people have been using this. Let's see if I can write some things. Over 300 years. These candlesticks are over 300 years. Some people think that candlestick is something new and has come up with internet. No, when people were drawing candlestick like this, that was more than 300 years ago in Japan. Okay, Japanese people, the farmers, when they were selling rice and other things, okay, they developed this way of looking at the chart, of looking at the price of, for example, rice or something else. And they discovered that there are patterns that are repeating. There are patterns in the price, how the price do from year to year or from week to week, or from, I don't know how, in which time frames they were calculating back then. Okay, so this is nothing new. EG is nothing new. It is not like it is developed last week by one of other scammer. You know, nothing is new in trading. Okay, and trading itself is probably up to at least 2,000 years old, maybe even older. No, in Middle East, people used to do trading back then, like 2,000-3,000 years ago. Okay, so that's trading, and candlesticks is at least 300 years old. In 80s or 90s, I think it was in 80s, this guy, Steve Nissen, I don't know how to pronounce his last name, Steve was the guy that brought candlestick knowledge to the West. Yeah, this was the first guy who made candlestick. So every one of us that knows about candlestick, everyone who has heard about candlestick is because of this guy. If this guy was not there, probably later on we will also have heard it from someone else. But it was this guy who made candlesticks popular. Okay, so he's the top G. He's the guy that knows the most about charts. He knows the most about candlesticks. Okay, but let me say something else. So he's the authority. He's the one who knows more than anyone else how chart work and how candles work. Okay, how much money, how rich do you think he is? How much money do you think he has made with trading? If he is the authority, if all of us, if all the strategies that you know are based on, most of the strategies, let's say that we know, are based on candlestick. And without him, there was no candlestick. So he's the grandfather of all strategies that we know. How much money do you think that guy, Steve, has made with trading? How rich has he become with trading? Zero, none, nothing, nada. Okay, and this is my point. The guy is authority in this, in charts. He knows 100 times more than I do. But why is he not making money? All the money that that guy has made has been through the courses that he have made. Okay, he's a consultant. He's a consultant and coach, and he teaches others how to read candlesticks. But he cannot trade, because trading, as I said, is a different skill than the skill of chart reading. You can be number one in chart reading. You can know all the strategies. You can know ins and out of EG or any other strategy, like our grandfather in trading, Steve, and you will not make money. Okay, so I'm saying this just to make it clear that the secret that you are looking for, that the missing link that you are looking for, will not be found in the charts. But charts are important, okay? Because as I said, charts are based on charts. We make a story for ourselves. We make an excuse for ourselves to get in a trade. And trading happens after we are in a trade. But that's a subject for the next time. And this one, this a little bit the opposite of Steve Nissen. I see him, I see him as my mentor. Because of him, I started trading again. Okay, Tom Hugard. Tom Hugard in the whole trading industry, he's the most honest guy in the whole trading industry. I'm following him now for 2 years, almost daily. But sometimes I was daily in his calls. Twice a day he goes live. Every London session and every New York session he's live trading. He's one of the only trader who trades every day twice live and for free. Okay, he doesn't charge any money. I'm also inspired by him. That's why I'm doing all of this for free. I don't want any money ever from anyone. Okay, because if my mentor, if the one that I've learned the most about trading from, this guy has more than 25 years of experience. And this guy, he is not good with charts. He's good. I'm not saying he's bad, but he's probably some of you now in the call know more about strategies, know more about charts than Tom Hugard. All his strategies are super simple, are very, very simple. If you look at his strategy, it is almost like childish. But every year he's making at least $1 million with those simple strategies because he understands trading. He is super good with taking losses. He's super good with when he has a good trade to make a lot of money with that trade. Okay, so that's why I have the picture of those two here. Although this guy, he knows far more than Tom Hugard about charts and about strategies. He has never made money, and Tom Hugard is truly now one of the best traders that we have in the whole industry. Okay, so that was the base, that was the, let's say, the context in which we are going to speak. Okay, let me see. The EG is so to understand EG, we need to understand candlestick. Okay, this is for beginner. I hope I will do this very fast. How do we do this? Move it here. Okay. Any candlestick, it has 4 points, 4 price points. Okay. This is a bullish candle. It means whenever the candle is green, it means the price started at this point. Let me see. Just the price like this to make it. So this was this point. So the price of the, let's just imagine this is one day. We look at the price of last day, or last hour, or last month, or last week. But just for this example for beginners, this was yesterday. Okay. Yes, when yesterday started, okay, when the morning started, the price of rice or the price of gold or the price of anything, it was 2000. Okay. Is it 2000 that I've heard? Yeah. Okay. After it went uh, after it went down to 1000, let's say 900, for example. Okay. So we start at 2000, that's this line. Price went down and then it go up. I will copy. Then it go up to the top. In the top, what should we make it? Let's make it 3000. And one more. What should we make this? 2900. 2900. Okay. This is clear so far, huh? So open, this is we called open, low, high, close. Open, low, high, close. So based on this, okay, if you just look at the numbers would be like this. It's a little bit confusing to read. So that's why the Japanese, they made this candlestick to make this more easier to see what has happened. Okay, so we know the price at the beginning of the day, on the start of the day, was 2000. After it went down, it goes up and it closed here. This is what we call a bullish candle. And a bearish candle, I don't have to make this because otherwise, really, I feel like I'm explaining it to a 5 years old guy. The bearish is exactly the opposite. Okay, for the bearish, the open is at the high. So open, high, low, close. Okay, so it's the opposite. So if the price opens, the reason why this is red and this is green is because the open, I mean the close is below the open. If the close is below the open, it is red. If the close is above the open, this is open, this is close. If the close is above the open, the candle will be green. Okay, this is the most basic baby steps of candlesticks, but this is needed to get into EG. Okay, and then we go a little bit lower. So now we understand the difference between those two types of candles. And when will EG happen? This is an EG. Let's say yesterday or day before yesterday, the price was this. Price started here, it went up, went down, it closes here. So the day was red. But the day after that, the opposite happened. So now we started here, price went down, price went up, and price closed above the high of the day before. After this happens, okay, after that happened, this is a very important step. Opa, what happened now? This is a very important step. After that happened, can I change this color? white or to transparent. Yeah. Yeah. After this happened, so we know the day before the price had done this. Okay. And then just imagine farmers were doing this like 300 years ago. This is nothing new. Okay. Farmers would draw this with pen and paper. I don't even know which kind of pen and papers they had like 300 years ago. But they were drawing this. Okay. Because they knew, okay, the price of rice was here and it went up and it closed here, but the day after or the year after, it doesn't matter. This could be a year, this could be a month, this could be a week, okay, this could be an hour, but we know. But now we are looking at the day by day. So one day was this, but the second day, the price has done this. So for the farmers, this was very easy because even without knowing the price, you know something have shifted in the price of rice. In our example, the price of gold. Okay, please don't send me messages right now. Okay, so after this happened, this is what we call engulfing. Engulfing just means simply this candle today has engulfed the last day's candle. Okay, it has closed the close. This is the close is higher than the high of the day before. Okay, some people even consider this as engulfing. Okay, as long as the close has not closed above the high, but has closed above the open, they still consider that as engulfing. But we don't do that. Okay. So for us, it's better to look at close above the high. Okay. So this is basically this is all what engulfing is. Very simple. This is all what engulfing is. One day price was doing this. We thought it will go down, but the day after or the month after, price make this. So now we can again. Now we go back to gambling because it's always the gamble. We never know for 100% sure what the price will do. So we need to become very good with the idea of taking risk. If you are not comfortable with taking risk, you will do everything to avoid risk. So you will then you will not trade. Okay. So after this happened, and one other assumption that we make when this happened, this is what they call a breakout. Okay. When you hear about breakout, someone saying breakout, this is a breakout because we broke above the high of the previous candle. And when a breakout happen, more often than not always, like nothing in trading is always. But we know when this happens, the chance is very high that the price will drop, okay, and then go higher. This is all our strategy. All our strategy is based on this assumption that when this is higher than this, then our assumption is that the price will come lower and then go high more often than this, because the price can also just do, after this has happened, the next day or the next hour, the price will just go, and believe me, this happens many times. Okay. So that's why I said this is not a science. Okay? But more often than not, the price does retrace back into the zone, and from here it goes up. And it is up to me and you to understand the strategy, to know what we should be looking for when the price comes in. Okay? When the price comes here, you can basically, let's say this is, to make it more simple, let's say this is a H4, H1 candles. H1 candles, technically you could, when the price comes in, so the price has closed, it has gone up and come down and it closed here. Let's say the next hour, the moment the price touched here, technically you could buy. Okay, technically you could buy and then the price will go up. All right, or you buy here and the price will go a little bit down, maybe here, do some things and then go up. So technically you could just directly buy, but that is very high risk. And to do that, your stop loss need to be all the way in the down. So we don't do that. What we do is, okay, so this is clear. So what we do is then we do multi-time frame analysis. When this has happened, we go one time frame lower or two time frame lower. And then we see if this same pattern repeat itself in one time frame lower. Okay. One of the SOPs that we use is the H4, M30, and M5. Okay. If each one of these candles is H4, a Zoom call will end in 10 minutes. I will see if I can finish this in 10 minutes. After we will take a rest and come back. Okay. But I'm sorry for the advanced students in the group. This is really necessary that we make this, okay, for the beginners. And I hope today we have enough time to explain some other things. And if not, I'm here every day, so don't worry. Okay.
Yeah, carry on.
Okay. So the assumption is this. Let's say, for example, one of our SOP is, I will show you the SOPs that we have. Imagine that each SOP, and an SOP is nothing else than just few time frames. Very simple. Think very simple. Okay. Some SOPs are based on one time frame. Some SOPs have two time frames, three time frames, or four time frames. Be very flexible. As I said, there is no science. Nobody has tested, nobody has scientific proof that this time frame is better than this time frames, that these time frames are better than these time frames. Okay, these are all our observations. Which one to use? Okay, this is more for the advanced ones, advanced students. Which one you use depends on the